send an Uber to your place. It's my secret safe. Safe with just you and me. We can leave a trace. This is my favorite mistake. Oh, look in my eyes. Can you find the light? Do you feel alive? Look in my eyes. Do you mind the lies? Do you feel alive? Look in my eyes. We both know it's wrong, but you're still coming over. Even when you're gone, the feeling just grows stronger. Should leave it alone, but you're still getting closer. We both know it's wrong, can't keep this for long. All that's going on, put it in a song. Are you on your way? Are you coming through to me? I'm getting impatient. Oh, look at what you do to me. Our secret's safe, so you're my favorite mistake. That's why we gotta keep it on the low. Got a hunger, she don't need to know what's going on. It won't be on for long. Oh, look in my eyes. Can you find the lies? Do you feel alive? Look in my eyes. Do you mind the lies? Do you feel alive? Look in my eyes. We both know it's wrong, but you're still coming over. Even when you're gone, the feeling just grows strong. You leave it alone, but you're still getting closer. We both know it's wrong, can't keep this for long. All that's going on, put it in a song.
All right, good evening, good evening, good evening. We're going to go ahead and get started. My name is Jamal Hutchinson, originally from Atlanta, Georgia. I've been in Nashville, Tennessee for over 27 years now. So originally came to Nashville to go to school. My big goal then was I wanted to build my own city. So I majored in engineering. My last year in school, I decided I wanted to do something totally different, and ended up getting a degree, finished my degree out, but I got my master's in public administration. And along that way, I ended up getting married. My wife and I, we had 5 kids. And throughout that process, I was still trying to figure it out, trying to figure out what I wanted to do. I knew I wanted to build my own community, but I was finding different ways to do it. Got called by the teaching bug, went back to school and got another master's degree. So I've been in education. I was doing social work and did some nonprofit work, did some work with the youth. Ended up getting let go from the metro school system for teachers here. Ended up going to higher education, and I got another degree in between that to become assistant principal. Basically, I had to have a certification in order to apply to be an assistant principal or principal here in the school system. That didn't really pan out. So what I kind of tell people is I just use all of my experience, all of my schooling to kind of merge everything together. So I help people plan, social engineer, come up with strategies that can get them to the next level. My current position right now, I've been owner for almost 8 years, been full-time in the financial service industry for 7 years. And we just really focus in on educating people about how money works. This month is Life Insurance Awareness Month, and we wanted to really focus in on the IUL. It's been a hot topic over social media for probably the last 2 or 3 years. It's getting a lot of more attention, especially in different demographic groups because of social media. Tonight, our goal is very simple. We just want to get down to talking about this whole family banking strategy. We want to really dive into how that works. And I actually forgot a picture to put in the slide but we will get into it when it's time for about books to read. Yes, I definitely want to show what are some resources and things of that nature. But today, the whole purpose is we want to really dive into what is this family banking strategy. So, if there's any questions, make sure you drop it in the chat. This is being recorded. We will put it up on our YouTube page that you can check out for later on. So, rest of this, we have one more Wednesday left in the month. It's going to be talking about leveraging IULs in real estate. I have a couple good senior partners that I'm partnering with to put this on. We're going to really dive into this whole leveraging life insurance to do real estate plays and how does it work. So if you know any real estate agents that's out there, please definitely shoot them our way so we can dive into those topics and have them be a part of that. You can do the general registration is right here at the very bottom. We do release the link, so you can follow me on IG at King Jamal 1906, or just look up King Jamal Hutchison on Facebook, and the information will be there as well. So this is our third series, and I'm going to kind of just dive right into it. So as a financial strategist, as a financial consultant, basically the main cornerstones that we want to put in place are protection, growth, safety nets, and tax advantages. The great thing about the IUL is that it does all four. So normally when I sit down with the person, is really explaining to them, how do all of these four fit into your portfolio? Do you have it in your portfolio? And then what does it look like for you to begin this process? So ideally, when we sit down with a family, we want to get into what we call a full care package. This family banking strategy is one of our items that we customize for our clients and see if it fits their budget and if it's appropriate for their portfolio right now. Now, I am biased, straight up biased. I'm going to tell you that I do suggest that you have this in your portfolio to go along with your other investment and retirement strategies. This is a solid plan, it's a conservative plan, and there's different ways that you can leverage and use this plan to make it your own. So one of the main things that I do want to kind of get into, we'll dive into a little bit more, is that you have to understand there's different types of insurance. You have term and you have permanent. Term means you only have it for a short period of time. Permanent means you have it for the duration of your lifetime. So there's different advantages for each one. Really, when I sit down with somebody, I really want to dive into like, what are your goals? What are your dreams? What's the purpose of this life insurance? Because each one serves a purpose. Each one serves a purpose. The family banking strategy typically can be done in any form of permanent policy. You people who prefer the whole life aspect to build a family bank. I wouldn't do one with the universal life. With the regular universal life, the only problem is that you have the cash value is tied to market risk. So what that pretty much means is that if the market is doing good, you're doing good with your money. If the market's doing bad, the cash value that you want to leverage for that family banking strategy is going to cause some problems. You could have enough funds, you could have no funds. So the main thing we want to get into tonight is, what is this new IUL product? It's not that new, but I think a lot of people get more exposed to it and going from there. All right, so quick recap. Take a screenshot if you want. Life insurance is grandfathered in because of this tax code called 1913 back in this tax code called 7702A that was started back in 1913. All it's saying is that anything inside of a life insurance policy, you're able to grow your money tax-free, you're able to put that money out tax-free. That's one of the foundations of this IUL. Go back and reference the other videos. We talk about the Rule of 72, compound interest, what's the difference between fixed, variable, or index growth. This is an index growth. All that means is that when the market grows, you grow. When the market tanks, you're locked in. So you never lose. Keep this in mind, when you never lose, you can always win. Also, really to point out that this is not an investment strategy. Your stocks, your different things in your portfolio, those are investment strategies. this can be a retirement strategy. And so typically what I see is that when most people are sitting down with somebody, their retirement and investment strategies are merged together, right? What I appreciate is that you need to separate the two. You know, if you're investing, it's going to be some kind of risk. You got to have some investment strategies in our portfolio. If I'm saving for retirement, make it make sense to me why you're losing money in retirement account. If I'm saving for my retirement, should I be losing money? Yes or no? It's not cookie cutter. It's just really straightforward. So what are some accounts that I can put some money in that I won't lose any money? It can be used for retirement. Life insurance is one of those ways. This family banking strategy is how we put that together. So what we typically tell people is that this IUL, Index Universal Life, has several different features. You got the liquidity of a bank in so many aspects. It's safe. It does have a decent rate of return over the last 25 years. It's been averaging between 8 to 10%. And then it's tax-free. So what we do know is that 80% of people are putting in money in banks. 15% of people are doing some kind of investment strategy. Only 5% of people are actually using this insurance strategy to build their wealth. Insurance is uncapped. There's no cap on how much money you can put into an insurance policy. All right. So a lot of different things you can do with it. Some of the benefits is protect your family, your health, and your wealth, protected against IRS, inflation, creditors, and predators. All right. It's a lot of different things. Just a quick overview. So now let's get into, some of these myths, some of these, and what's reality. Myth number one, you need to be wealthy to implement the family and banking strategy. Our company, we focus in on middle America. That's our target market. And we can work with anybody and everybody, but truth be told, there's not enough resources going towards the average family household when it comes to putting together a financial plan for their future. Typically, what we see from middle income families is that they're just doing the basics. They got a small savings plan, they got a 401k, they may have a side gig, but not really a business. Whereas, the people who are a little bit wealthy, they have a financial planner, they have a financial team, they got an accountant, they got this, that, they got permanent insurance, they're doing this and that, but they're paying for that service. The thing about us is that we don't charge for our service. All right. So you want to get with us, it's going to be a QR code a little bit later. You can scan a QR code. We get paid on the back end. So we're literally here to help people grow their money, protect their money, and make it work for them. The average family can use an IUL to gradually build cash value. This is customizable to your family. So what we really will work on is what we call a personal financial need analysis. We're going to do a breakdown of your finances. We're going to try to help you find some money. All right. What we do know is that we are not saving enough money. So there's more money coming in than month. We need to find out where that money is going and then assigning the job. If you need to make more money, then right now, this is not for you. So how does an average family person afford an IUL or leverage this banking strategy? Really what's going to boil down to is how much can you put aside each month comfortably without missing it? This is kind of like let it sit and let it grow. Let it sit and let it grow. This is not for quick flips. The family banking strategy, when it's done right for the average American family, this is not a quick flip. This is not the thing we see on Instagram or TikTok where I dump in $100,000 today, tomorrow I can pull out $90,000. That's not what this is designed to do. But for an average family, you can contribute to this policy at least 20, 25, maybe even 30 years, depending on how old you are, to do some different things to add to your portfolio of retirement strategies. All right. It has to be designed, customizable to you and everybody else. Right. So myth number two, it's too complicated for the average person. All right. So what are the steps to starting your own family bank? Well, step number one is schedule an appointment with either me or one of my agents. And we'll put up our Calendly or our information at the end of this meeting. Sit down with somebody who can guide you through this process. It is very straightforward. You're going to contribute a certain amount based upon your budget. You're going to understand by reading some books, The Retirement Miracle, The Power of Zero, Money, Wealth, and Life Insurance, of how this policy actually works. You're going to extend the loans. It's not that difficult. Basically, what you're doing is you're going to give us a budget. We're going to work with you on that budget. We can provide the illustrations to show what this can do over a period of time. We're going to meet at least twice a year. Do a mid-year review and then an annual review. You're going to apply for the policy. Now, here's the kicker. You do have to qualify medically for it. Our agents will walk you through those medical questions and to see if this is really appropriate for you and your household. As you submit your application, what's going to happen next is going to go to what we call an underwriter, case manager, so to speak. Case manager is going to pull some records, determine your risk. Insurance is risk is risk assessment. How risky are you? They're going to go through that process. Then once we get an approval, we're going to sit back down. We're going to go over whether or not did you overcommit, did you undercommit, do these numbers work for you, et cetera, et cetera. Once we go over those numbers, you're going to sign for your policy. You're good to go. You're able to access your information. Typically, you're going to wait for an annual statement to see your credits on your account. This is not like your stocks where you can look at it every day. It's not what we're going to do. We don't look at it every day. All right. So let's talk about a quick example of a family doing one for their 1-year-old. We did this last week, but I want to get right back into it. So when we look at how this strategy works, this is assuming that they're getting about a 7.44% interest rate. This is going to go up and down, but on average, we say they average about 8%. They got about $300,000 in coverage. And then what's going to happen next is they're going to put in about $200 every month for 18 years. And what we're going to see is that this is going to gain some cash value over those years. I'm trying to pull up something real quick just to make sure that we have everything in place. So cash value. So in the first few months, you don't see a lot of cash. First few years, you don't see a lot of cash value. And that's okay. They're just doing a little bit over the minimum for this particular policy. Now, what's going to happen next is, some of the benefits of this is that it's also tax-free growth. And then when they turn 18, they're going to take a $3,000 graduation trip. They have about almost $60,000 in cash value. It's going to stop contributing at age 19. Down the line, look, they can contribute to for college. They can pull out about $6,000 a year. When they turn 28, they can pull out a $15,000 down payment as a loan to themselves. Family banking strategy, your own bank, pay for that down payment versus trying to get that finance. And so, what have we done? We paid $60K for college. We took out a $15,000 down payment. We took out $3K for a graduation trip. We still have $54,000 left into this account. It is still earning interest at 136. Right? The loan they took out on the account is still earning interest. And then what we see is that when they turn 65, they have created $1 million baby. Okay. From there, what you set up for your kid is that they can pour down almost $50,000 until they turn 90 years old. Okay. And so what does that actually mean? So that means also that if they pass, when they pass the 90 years old, they've they took out about $1.37 million, and they're going to pass on about 4.285 million tax free to their grandchildren. All right. So myth number three, it's the same as traditional life insurance. No, this is not the same as traditional life insurance. This is uh, this is a permanent policy. It's like before, you have to understand that these policies gain cash value. Term policies do not. Term policies serve a purpose. Uh, this is using a index strategy. This is a souped up version of what we've seen in the past. 98% of term policies don't pay out. So when you get with us, we talk about using leveraging like a life insurance policy to living benefits to be attached to your IUL. So big difference. You got to understand term versus permanent, term versus permanent, term versus permanent. All right, this is the big kicker, and this has to be really customized to you, and depending on which company you pick, is how they're going to allow you to borrow money from yourself. All right, this is so there's two types of loans. This is a declared loan or regular loan or alternative loan. When you do the traditional loan from the policy, you're going to get charged an interest rate for borrowing that money, and then you get a rebate. Sometimes that rebate is a helps that loan to be a wash loan, and sometimes you still got to pay a small percentage on that particular loan. With the alternative loan, what pretty much is happening is that you're going to be borrowing money from your policy, is the family banking strategy, and then when you borrow money from your policy, your cumulative value is still going to be in the market. You're going to take $50,000 away from, let's say you borrow $50,000 from your policy as an alternative loan. You can put that money back in, or you don't have to. Okay, so this alternative loan is still going to have your money accumulating, 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 and then once you make the profit, you can put that money back into your policy again to make it whole. But you don't have to. You can wait till you died, and it can pull from your death benefit down the line. Two types of loan. It's a question you got to ask. What are the different types of loans for my IUL? Each company is different. So what I always preach to my clients is that you want to understand the concept, like fall in love with the concept, not the product. There's always going to be a new product out there. Allianz has a great IUL. Nationwide has a great IUL. Prudential has a great IUL. Transamerica has a great IUL. There are some companies that their IULs aren't as strong. You should get with us and we can talk about the difference between the different IULs. But when I'm trying to implement this family banking strategy, that loan type really matters. If I'm going to borrow for myself, do you still want to have this your accumulated value still growing as if it was still in there, or do you want something different to happen? So it's not complicated. It can be really, we can make it very simple for our clients to understand. But part of doing this family banking strategy is understanding how we can leverage that alternative loan to go in and borrow, put the money back in if you want to, or just let it sit and continue to rinse and repeat, rinse and repeat, rinse and repeat, rinse and repeat. All right. Uh, well, so let's kind of dive into some real world examples. So one of the main things is, does this work for an average family? Yes, it does. It depends on how much you can contribute to it. Let's do a 45-year-old. Uh, Here we go. Put them on a hiccup. Let's do a quick case study. So let's dive into what does this look like for the average family. So let's just say I have a client who's 45 years old, but he has not started saving yet. So one of the hard questions is that, hey, listen, you're starting late. You have to contribute more in order for you to kind of reach some of your goals. But this is a good strategy to have in your portfolio. So at the end all be all, you can tell me any logical reason why you shouldn't have this in your portfolio. Please let me know. Okay. So what are some of the benefits? Okay, so first of all, this person is 45 years old, their average health, standing non-tobacco. This is called him John X, right? He has he has the IRC 7702A. That just means basically money grows in your tax-free. You can put his money down tax-free as well. All right. He also has long-term care. So 2% of this death benefit value is what he can have for 50 months. If anything was to happen, he can't perform 2 daily living activities. He can actually pull from the value of his debt from his death benefit to serve as long-term care. All right. He is going to overfund this policy. With IULs, remember you have a minimum and a maximum. You have a minimum, you have a maximum. The minimum he can put in for this policy is 150. The max he can put in is almost 1,300. So for this first scenario, we want to overfund the policy from day one, and what can happen from that. All right. So what you can look at is your net surrender value and your accumulated value. For this particular company, your net value and your accumulated value become the same in year 10. But along the way, he still has access to this money right here. So let's just say in year 5, there was an opportunity for him to go into a real estate adventure. He has a group of friends. They're going to combine, create an LLC. They're going to get paid off how much they put into that particular policy. So he just needs $20,000. He can come in here, borrow $20,000. This accumulated value is still going to act as if it's still in the market. The market does good, he does good. When the market drops, he's locked in. We're doing a conservative 6%. I said on before, he's average between 8 to 10% over 25-year period. 20-year period. We're going to ask him to contribute for at least 25 years. Listen, you need time is money, money is time. The later you wait, the more money to put in, or the more time you got to put in. It's kind of catch 22. So that's what he has right here. Now, at retirement age, he has almost $400,000. Waits 5 more years, he has about $600,000 that he can pull down. He has access to that he can leverage. So if he wanted to use it as a tax-free vehicle, at minimum, he can put down $20,000. But along the way, all of this net surrender value is what he has access to. So if I want to put in $10,000 for a quick real estate play, not quick real estate play, but for a real estate play, I have that option. If there is, in year 10, if I find out, say, hey, we're building an amusement park here in this great time, this great city, there may be some opportunities for an investment. We need $50,000 within the next 3 weeks. You can say, hey, we'll put together a group of guys who can contribute a certain amount. He doesn't have to go to the bank. He can come in here, borrow money from himself, put it in that investment group. They go put in for that particular product, and then they're good to go. So that's one of the things that he can do. So what else? So some of the benefits. Number one is death benefits, tax-free growth. You can pull money out when you want to. Your principal is guaranteed to be in there. All right. This other strategy. Well, let's say he passes at 90 years old. He has borrowed almost $440,000 from himself, and he still can pass on almost $800,000 to his loved ones, tax-free. There's a lot of different things you can do with this. Now, Jamal, what's the scenario if I can't do 1,300 off top, but I still want to get started? Great things about these is that you have customizable payments. customizable payments. You can put in a little bit as you want or as much as you want. And it still will lock in your gain. You still can benefit from compound interest. It's just the amount of money it's compounding is going to be a little bit different. So same scenario, we call this a ladder strategy. So what's going to happen is those first 3 years, maybe he just does $500 a month, $6,000 a year. Then he bumps it up to 12,000 a year, which is pretty much $1,000 a month. Then he maxes it out for the rest of the time period. What's going to change is just how much money do you have access to? That's all it is that when I'm maxing it out, my cash value grows faster because there's more money compounding. Still the same thing, year 10, I may not have the $50,000, $60,000 if I'm doing a match contribution. But basically what I'm going to do is I'm just going to contribute. I can still pour down my $10,000 for $20,000 down for a down payment, or there's any other different strategy to still have access to this money right here. All right. So it still works. The biggest difference is just how much money you have tax free, and then what do you have access to when you pass. So listen, there's no 59 and a half rules. There's no 72 and a half rules. There's no RMD rules. If you got an emergency, you still can pull from your surrender value. And you can have multiple, of these policies. So instead of the 22K, he has 14K, but he still can pass down his $800,000 to his loved ones when he passes. Instead of borrowing 440, he borrowed 350. Still works. You still have access to this money that you can use at any point in time that you want to use it for. So whether it's for a car, a boat, a traveling trip, you can pull from the value of death benefit to take care of yourself. So let's make this really plain. Let's make this really simple. Understand the basis of the IUL. Our whole purpose over these last 3 weeks was to expose people to more of how does this IUL work? What are your goals? What are your dreams? Cool. Now let's decide on the premium amount. How much you're going to pay per month comfortably that you don't have to worry about. Then we're going to look at the different types of policies or which one actually fits you. And then you're going to benefit from the market growth, and then we're going to secure your future. Please scan the code as a referral so we can see what's going on and go from there. Our next upcoming webinar is going to be the $1 Million Baby Strategy. It's going to happen. This is the wrong flyer. It's going to happen next month. But thank you for being here. If you got any questions, please just reach out to us. My name is Jamal. Have a blessed day. Some blessings.